Today we're going to be covering the 4 main ways that real estate investing makes you money here in Canada specifically. Okay, so welcome back to another video. In case you are new here, my name is Cody Newstater. I'm a realtor and investor here in the Winnipeg market. And like I said, today we're covering the 4 main ways that real estate investing specifically makes you money. Real estate investing is one of the best ways to generate passive income. It offers multiple revenue streams, including cash flow, appreciation, your loan paydown, and tax benefits. And there are more, but we're going to just cover the 4 main ways today. Now, first, I always like to discuss cash flow because that seems to be the most prevalent one and the one that most people know about. And so cash flow is pretty simple. It's simply your income minus your expenses gives you your cash flow. Sometimes people call it your net operating income. And that's when you treat it more as a business compared to just a property. Okay, and so some of your common expenses are your mortgage payment, any taxes associated with the property, utilities if you're paying that, your house insurance, and then we always like to have some soft variable costs like your vacancy, maintenance costs, and then capital expenditure as well. And so when you take your rental income and maybe some parking income or laundry income, if it's a coin op, and you subtract all of your expenses, you're left with a net number. Sometimes it's negative, meaning it's not a good deal, but you're left with a net number that shows you your cash flow for the property. So an example, if you have an income of $1,800 from rent and your mortgage, utilities, insurance, taxes are around $1,200, and then you save $300 for soft costs, your cash flow is around $300. Okay, and if this is all overwhelming or you're not good at math, just comment the word cash flow and I'll send you a link to my free cash flow calculator that you can use to underwrite any deal here in Winnipeg. Okay, so after cash flow, we have appreciation, and this is the true wealth builder of real estate. This is the traditional form of real estate, why people buy it, and this is really the measure of your property value going up over time. Appreciation is based on inflation, but also supply and demand. In Winnipeg, over the last 20 years, appreciation has been around a 6% annual rate. Now, obviously, that's an average number, and your house or your investment can vary, but that's the average number over the last 20 years. So if we use the rule of 72 to calculate your how long it would take your property value to double, we find that 72 divided by 6 gives you 12 years for your property to double in value. And so if you think about a 25-year mortgage, that's approximately 2 times doubling, or 4 times. And so over your 25-year mortgage, your property value will approximately go up by 4 times if it has that 6% appreciation rate. Now, appreciation, while people like to call it speculation, there are ways to force appreciation. Usually that's through renovations, where you improve the quality of your property so its value actually goes up more relative to the current market than it would if you hadn't done the renovation. Now, there are a bunch of other ways that you can force appreciation, or sometimes we actually like to call it bought appreciation, where you buy under value. But for now, let's just consider it the value of your asset going up over time at a percentage of the purchase price. Okay, so the third way you make money through real estate investing is actually one of my favorites, and it's sort of like a hidden wealth builder because you don't really realize it or see it until you actually sell the property, and that's your loan paydown. You see, when you own a rental property, you actually have your tenant paying down your mortgage. And so because of that, the more the tenant pays down, the more equity you own in your property, or the more of the property you own outright. The best part about this is that when you pay down a mortgage, based on how capital gains is currently taxed, it's your purchase price minus your, it's your sold price minus your purchase price. And so any equity you've gone from paying down your mortgage is not taxed as capital gains. The only downside to paying down your loan is that it's not realized until you actually sell the property. And so while it's a hidden wealth builder, it's also sort of a forced savings mechanism that allows you to generate wealth over time. Okay, and the last way that real estate makes you money is through tax benefits. And I will say I'm not a tax expert, so don't take this as legal tax advice, but through the Canadian government, there are certain tax write-offs that you can claim because you are a rental property investor. And I've overlaid them here on the screen, but the biggest ones are your property tax, your insurance, your utilities, your mortgage interest, so any interest on your mortgage payment, and your legal fees, which includes lawyer fees. And so if you aren't self-managing and you have a property manager who's looking over your property, that's actually a tax write-off as well. Okay, so now that we've outlined the 4 ways that real estate sort of makes you money, I think it's important to sort of rank them, because there has been a lot of real estate investor influence that says cash flow is the best, and there's other people that say cash flow is useless. Don't do, like, only go after appreciation. And while I think it's important that you should probably not ever be in a negative cash flow scenario unless you have a lot of excess money where you can take the hit and it's a crazy appreciation rate, you want to be in a position where you have a positive appreciation and a good cash flow, which is usually going to be in better areas. That's why people like to invest in better areas of different cities. But if I had to put a number to them, my number one would be appreciation, because I think that's the best way to build wealth over time. And real estate is a long game, it's not a short one. And then my second one would actually be the loan pay down, because like I talked about how it's sort of a secret wealth builder and a forced savings. And because of the benefit that your equity that you gain from your tenant paying down your loan is currently not taxed by capital gains, that's a huge bonus. Because if you buy a $500,000 property and you have a mortgage of $400,000 over 25 or 30 years, that's $400,000 of tax-free income that you've had somebody else pay for you. And then my third one would actually be the tax benefits. And this does change if you're in a corporation or you're buying personally. But right now the tax benefits in Canada aren't quite as good as they are in the States. And again, this is not tax advice, but currently if you're buying in your personal name, tax benefits aren't that great. They do subsidize some of your income, but you can't get it to the point where you actually have a huge loss on paper to remove all of your income like you can in the States. And then my last one would actually be obviously cash flow, because while cash flow is nice to cover the cost of your rental property, I think cash flow is a better metric of considering how much effort you're putting into a property to reap the benefits of the other three methods, right? And so your cash flow covers your expenses so that you can have appreciation. It covers your mortgage payment so that your tenant pays down your loan, and it covers your, it gives you some tax benefits that apply to the property. Your cash flow is really just some money on top of that that's paid to you for the effort of owning the property. If you can cash flow really well, great. I would take that money and reinvest it. I wouldn't live off it because it's usually not guaranteed. Because the problem is sometimes you'll run into occurrences where your tenant doesn't pay, or you have savings but your furnace and your AC break in the same month, and then you're actually taking a loss on the property that year. And because of that, I think cash flow is not a metric that you want to bank on. And appreciation, loan pay down, tax benefits are a little more concrete. Obviously the appreciation can fluctuate a bit on the market, but they're a little more concrete that you can actually base your portfolio off of those. The cash flow is going to be more of at the end of year, you consider your profit and your loss for each property, and you look at your total portfolio to see how they performed. So there you have it. What do you guys think about investing in real estate as passive income? Are you ready to stop your investment journey? Drop a comment below. Let me know. If you are interested in investing in Winnipeg, reach out. My contact details will be in the description. So you can reach out, we can get started on finding you a way to get passive income and start building your wealth through real estate.